this month, I think there have been 9 so far, large bankruptcies. That would be bankruptcies with companies for companies with 50 million or more in liabilities. So that is tracking at the fastest pace since the pandemic first hit. It looks like we're going to see 25 large bankruptcies in June, and that would be larger than the peak after the pandemic hit of 23. So when you have these large bankruptcies, liquidations, what have you, you do have a loss of income, a complete loss of your paycheck.
We're going to do a Fed meeting recap with Danielle DiMartino Booth, CEO of QI Research. The Fed announced that they're going to keep rates unchanged at yesterday's meeting. So we're going to recap why they did this, what's next in terms of monetary policy, how many rate cuts are we getting this year and next. It was all revealed in the press conference yesterday. Danielle DiMartino Booth is going to break it down for us, give us an update on inflation and her views on the strength of the labor market and the economy overall and investment implications. So this episode is brought to you by iTrust Capital, an IRA that offers 35 crypto assets and the lowest trading fees in the crypto IRA space at 1%. If you'd like to learn more, get started, click on the link down below or scan the QR code here and find out more. If you use my referral link to sign up and get your account funded, you'll get a $100 funding bonus if you use my link. Danielle, welcome back to the show. Good to see you.
It's great to be here on this. Every Fed day feels like Super Bowl Sunday for me. So
even though nothing changed, it's still exciting for you.
Well, a lot changed. I mean, the dot plot changed dramatically. Yeah. So there was plenty that went on yesterday.
Okay, what was the biggest surprise for you, if anything, during the press conference or during his statement?
Well, so the Fed did not move its year-end unemployment rate target. In its summary projections, it left it at 4.0%, which happens to be where the unemployment rate is 6 months earlier than what it was projecting. So the fact that they raised their inflation expectations for their favored metric and did not touch GDP estimates, I found to be highly curious. And then they removed 2 dots from the dot plot such that there's only now 1 rate hike, presumably anticipated this year. From what the Fed is messaging, I would have to say in December.
Inflation, this is from the statement that Jerome Powell made.
Inflation has eased notably over the past 2 years, but remains above our longer-run goal of 2%. Total PCE prices rose 2.7% over the 12 months ending in April. Excluding the volatile food and energy categories, core PCE prices rose 2.8%.
My question is, Danielle, yesterday's core inflation data came in a little bit lower than consensus expectations. Do you think that was factored into the dot plots?
Well, actually, Chair Powell was asked that question directly, and he said that everybody had an opportunity to go back and change what their assessment was based on that lower than expected inflation print. And of course, this morning we got a lower than expected producer price index, which is going to feed into the Fed's favored measure of PCE and core PCE. So we actually expect to see downside heading into the Fed's favored metric as opposed to upside. I guess what I'm trying to convey, David, is I'm really confused by what the Fed was trying to communicate yesterday.
I'm just really impressed that they're sticking to their 2% target without deviation. At what point do you think they're going to say it's close enough? So the Bank of Canada, for example, also has a 2% target, but last I checked, the inflation rate in Canada is above 2%. It's around 2.7, which is roughly in line with the core PCE that the Fed's looking at, but they still cut rates last week, right? So, why isn't the Fed doing that?
The word that Powell used over and over again was sustainably. So I think they want to see that the numbers have not just declined, but they've stayed low. So I think if we get anything close to 2.5, 2.4%, I think that they'll be satisfied, and 2.4, 2.5% that stays there. I think that then they'll be satisfied that they are approaching their target with enough stickiness.
Do you think quantitative tightening alone would be enough to bring down inflation, or do you think they need to raise rates one more time?
I think that the bankruptcy cycle kicking into high gear is going to be enough to tame inflation. And so I look at it through a slightly different prism, if you will.
Bankruptcy cycle. Okay. Well, let's talk about that. What are you referring to exactly?
So this month, I think there have been 9 so far large bankruptcies. That would be bankruptcies with companies for companies with 50 million or more in liabilities. So that is tracking at the fastest pace since the pandemic first hit. And that it looks like we're going to see 25 large bankruptcies in June, and that would be larger than the peak after the pandemic hit of 23. So when you have these large bankruptcies, liquidations, what have you, you do have a loss of income, a complete loss of your paycheck. I also look at the fact that the economy has shed 1.5 million full-time positions in the last 6 months and only created 962,000 part-time positions in their place. So again, Americans are falling behind.
Okay. However, though, most of the labor force, as you know, reside in the small business side of America. This is from the latest NFIB report, May 2024 report. The NFIB Small Business Optimism Index reached the highest reading of the year in May at 90.5, a 0.8 point increase, but still the 29th month rather below the historical average of 98. The uncertainty index rose 9 points to 85, the highest reading since November 2020. Overall, how is that to be interpreted, Danielle?
I think that small businesses really uncertainty is toxic. So if you can't see over the horizon, then you're going to be very reticent to expand your business, capital expenditures. And they actually commented that financing had risen on their quote unquote worry wall because of the Fed's policies right now. So it's actually, they're making mention of how expensive it is to access credit. And on top of that, as you just said, this uncertainty index has gone through the roof. So very precarious times for the small businesses that produce 40% of jobs in America.
What do you think they're uncertain about? Interest rates, debt levels, consumer demand, inflation?
All of those things. They're really concerned about all of the factors that you just mentioned because they're all happening at the same time, in addition to a lot of this political overhang that we're going to have with us until after we get past the elections.
Okay. The labor market, according to Jerome Powell in a statement, is still strong. This is what he said exactly.
In the labor market, supply and demand conditions have come into better balance. Payroll job gains averaged 218,000 jobs per month in April and May, a pace that is still strong, but a bit below that seen in the first quarter. The unemployment rate ticked up, but remains low at 4%. Strong job creation over the past couple of years has been accompanied by an increase in the supply of workers, reflecting increases in participation among individuals aged 25 to 54 years and a continued strong pace of immigration. Nominal wage growth has eased over the past year, and the jobs to workers gap has narrowed. Overall, a broad set of indicators suggests that conditions in the labor market have returned to about where they stood on the eve of the pandemic. Relatively tight, but not overheated.
Is he right?
He's right that all of the benefits of the pandemic and the reopening and the surge of hiring that accompanied it have been normalized. He did, however, say that he was cognizant of the fact that payrolls may be overstated. And that was interesting to me because it was his first acknowledgement of the depth of the revisions that we've been seeing, which of course show us that net job losses began in the third quarter of 2023. And we know, again, I'll reference back to the bankruptcy cycle one more time. We know that since the third quarter of 2023, that the bankruptcy cycle has accelerated, meaning we know that the future revisions are going to be that much deeper when they do get released.
Okay, let's take a look at the dot plots. So if I'm correct in reading this right, Danielle, it looks to me that only one member has anticipated that the Fed funds rate will stay at 5% by 2025. In other words, everybody else thinks there's going to be multiple cuts into next year, right? How much credence do you give to this graph usually?
The thing about it is it moves around a lot. And it's very difficult to try and gauge what policy is going to be based on all of these individual dots. I will say that one dot that anticipates policy being very tight all the way through 2025 is probably Loretta Mester, the outgoing CEO of the Cleveland Fed. So that was her last vote at this June FOMC. And when you've got presidents of regional Federal Reserve districts on their way out, they tend to be much more hawkish than they would otherwise be if they knew that they were going to be sticking around.
So this is the key that I guess references this. He said,
if the economy evolves as expected, the median participant projects that the appropriate level of the federal funds rate will be 5.1% at the end of this year, 4.1% at the end of 2025, and 3.1% at the end of 2026.
That is a steep decline in the curve over the next 2 years. I wonder why he's not saying it's going to go down to near zero, which historically in past recessions has been the case.
Well, it's only historically been the case since 2008, December of 2008. That is when the Federal Reserve took the Fed funds rate to the zero bound for the first time ever. In all other prior recessions, it was highly unusual to see interest rates go below what they consider to be neutral. For me, at least, the takeaway there is that last time, when you looked out as far as you possibly could, the Fed funds rate ended with a 2 handle. And now they're saying it's going to end with a 3 handle. So that's actually a bit tighter than they were the last time they put together the summary of projections.
What is the equilibrium rate right now for the Federal Reserve?
No, I think that they think that it's 3.1%. Let's put it that way.
Okay. And that is subject to change usually, or is that like a hard target for them?
No, it's definitely subject to change. That's why I was saying it's so difficult to have any hard takeaways. The bottom line is this type thing from these dot plots, because again, they're moving targets. So we could get to September and they could go back from saying, in March, we said 3 rate cuts. In June, we said 1. In September, they could go back to saying, we see 2 if the unemployment rate keeps on rising. And we did see initial jobless claims come in at 242,000 this week. They've clearly broken out of where they had been range bound for so long.
Okay, so let's talk about the economy now and the labor market and some asset classes. So the GDP now forecast from the Atlanta Fed was revised upward recently on June 7th. It's now at 3.1% for the second quarter of 2024, up from 2.6% just the week before that. So they've revised it up based on, according to them, this morning's employment situation released from the BLS, that was last week, and this morning's wholesale trade report from the U.S. Census Bureau. It looks like, according to their data estimates, things are getting stronger, at least from the wholesale side. Is that true? Do you agree?
You know what? I'm going to have to push back on that because your wholesale sales to inventory ratio is in a very precarious place right now. We are seeing wholesale weakening, and we're also seeing involuntary inventory builds, which are never a good thing. That means that we're going to have an inventory correction that will itself play into GDP math. I would point out that most of the other economists, most of the other models on the street are still south of 2% for their projections.
You think 3.1% is a little bit too aggressive or optimistic for second quarter?
Yeah. Oh, yes. Yes. At this point, I certainly do. Yes.
Okay. Let's revisit the labor market. We talked about this in detail a couple of weeks ago. I encourage people to check that interview out. I'll put a link in the description below. What continues to be, I guess, the major risk for Americans in the labor force right now? You talked about the bankruptcy cycle. Surely that's not going to affect all industries equally, correct?
It will not affect all industries equally. Right now, we're seeing a lot of all things, colleges going out of business, colleges filing for Chapter 11. We're seeing a lot of healthcare companies file for Chapter 11. Consumer discretionary is another one that's getting hit pretty hard. And these are kind of your usual suspects, if you will. But I think the biggest tell right now for the workforce is the fact that layoffs are broadening out much more than they were in 2023. So they're going further into other industries, and we're seeing that in the cyclical economy, in the services economy, with employment weakening really across the board.
Do you think the rise of unemployment has hit critical mass? In other words, it's just going to continue rolling up from here?
I actually do. And this is kind of, it echoes a little bit with prior recessions, especially late 2007 into 2008, when the unemployment rate was kind of inching up 1/10 of a percentage point at a time. And then boop, it just kind of popped up by 3/10 of a percentage point and kept on rising aggressively after that. So I think you use the right terminology, which is critical mass.
Usually when people are expecting a slowdown in the economy or perhaps their jobs to be in danger, they spend less in anticipation of that. Are you seeing that right now in the PCE data?
We're seeing it play out in Bank of America weekly data on debit and credit card spending, which is very much more real time in nature. We also just saw the first contraction in credit card spending that we've seen in years. So that was also kind of indicative of households battening down the hatches if they're not relying on that plastic so much to kind of extend their ability to purchase.
Okay. Inflation adjusted PCE, annual percentage change is 2.7%, 2.6. It was 7% in June 2022. So you're right. The pace of spending has slowed down dramatically. What's next, do you think? Do you think people will start saving more? Do you think the savings rate will go up?
I think to the extent that American households are able to save more, we've seen a lot of emergency withdrawals from 401ks, taking loans out from retirement accounts. So I think a lot of Americans right now would love to have the luxury of being able to save more.
Defaults on loans, delinquencies, will that be affected as well?
Yes, we're seeing a very pronounced increase in delinquencies, whether you're talking about commercial real estate or the automobile sector on the consumer side. Of course, credit cards, buy now, pay later. These all have very quickly rising delinquency rates.
The 10-year Treasury yield yesterday, right after the FOMC meeting, fell by about, I can't remember exactly, but I think it was 1.4%. It was something dramatic. Is the bond market right? Are they, in projecting lower rates for later this year, I guess?
That goes back to your question, David, about whether or not the unemployment rate itself has momentum. And if that's the case, then the bond market is certainly right in pricing in that things are going to get a little hairy.
Why is the equity market not pricing that in? Well, I guess they are, but ignoring it because the equity markets was up yesterday. Yeah.
Yeah. The equity market tends to be the very, very, very last to capitulate. It tends to occur when the Fed begins to lower interest rates. We're certainly not there yet. In fact, the blow off top rally towards the end of a Fed cycle before they start to cut rates, that tends to be a good 10% rally in the stock market. Again, it's the very, very last thing to go.
So overall, then are you concerned at all for the equity markets for this particular point in time?
I think that to the extent that you want to be hedged, you don't necessarily need to play Russian roulette with your portfolio. It, of course, depends on when you're going to be retiring. But I think it all depends on your risk appetite and your time horizon at this point.
The sectors that you think are most at risk from layoffs, do you think that will translate to underperformance in those sectors of the S&P?
That's typically what we see. That is typically the roadmap that we see when companies are culling their payrolls. It's good for an initial pop in the stock price because investors say, yay, it's going to go straight to the bottom line. But the fact is, if they're not confident enough to expand, that means that it is their top line that's at risk.
Okay, so let's summarize the FOMC meeting from yesterday. Overall, would you say that Chair Powell's speech was hawkish?
I think it was. I think it was perceived as being fairly hawkish because he did talk up the labor market, as you said. He did validate raising the inflation expectations in the summary of economic projections, despite the fact that there was a lower than what was forecasted CPI print. So, he could have pushed back against any number of factors, but he didn't. He chose to stick with his resolute hawkish stance.
Okay. We haven't talked about your inflation forecast yet. So yes, the labor market should deteriorate according to your stance. What about inflation? Would that mirror the deterioration of the labor market and go down some more or stay sticky above 2.7?
I fully anticipate that we're going to see declines in inflation. We have the last domino to fall, if you will, is going to be shelter inflation. But we're already seeing in private surveys the cost of shelter coming down, and even home prices have begun to turn in certain markets. So while it's going to be with a lag, we've already got very deep goods deflation, and we've even got services inflation on the cusp of turning negative as well. So the Fed's job is pretty much done here.
Done in terms of that the trajectory for a rate cut is basically set in stone. Is that what you're saying?
I was very surprised to see that they reduced the number of anticipated rate cuts in 2024 from 3 to 1, given how the unemployment rate typically behaves once it does get this upward momentum. So it remains to be seen, but I think that the Fed might have to go back and revisit the number of rate cuts it anticipates making in 2024 when the September summary of economic projections is released September the 18th.
Would you say it is a high chance, or there is a high chance, that inflation will return once the Fed cuts, either by 1 or 2 times?
Certainly not if the Fed's going to be doing very small rate cuts of a quarter of a percentage point. That's really not going to move the needle. In fact, you're still going to have the vestiges of quantitative tightening working their way through the system.
Why is the DXY not higher than it is, considering that other central banks are lowering the rates or have already done so, and the Fed not yet?
Well, it's all relative, right? I think there is an anticipation that the Fed is going to lower rates, and I think that that's why you're seeing the dollar be kind of confined at this juncture. But given all of the far right victories in Europe, I certainly wouldn't bank on the euro or the Japanese yen appreciating that much here in the near term. So again, the dollar is holding its own as with its traditional role of being the best looking horse in the glue factory.
Okay. I want to finish off by just talking about your outlook for thematic investment issues. So one of the things that's happening this year is that there's going to be a lot of elections. In fact, I read somewhere that a large percentage of the world is going to see elections this year, potentially a paradigm shift, potentially not. Are you looking at that? Is anything to be noted?
I think that we should really pay close attention to what's happening in these other elections, because I think the swing to the far right is something that is born of divisiveness on a global level. So I think Americans should be very attentive to what's happening in the rest of the world right now, because our elections are so very close. And when you see what's happening with, say, the French sovereign bond market, the disruption that's flowing through that, you have to be aware that there could be parallel moves in the U.S. financial markets following our elections.
Are we going to see more protectionism? Are we going to see less globalization as a result of swinging to the right?
I think that there's that is the base case, but we have to remember that India and Mexico are still our allies. And that the potential to forge deeper trade ties with those two countries is immense going forward. So I think that while we're closing off the channels of globalization in certain areas of the world, that we've got the potential to open them in others at this point. But yes, you are correct that there is going to be more nationalism, more protectionism, probably higher tariffs if Trump does happen to win the White House. We'll tack $1 trillion onto the deficit almost on day one, because he'll not allow those tax cuts to sunset. So, the nation's finances are in something of a shambles. So you have to look closely, I think, to the outcome of the Senate races to determine whether or not there's going to be any fiscal sanity inside the Beltway.
All right. Finally, tell us about what you're working on these days at QI Research.
So, right now we're looking very closely at the banking system. The non-performing loans have really started to accelerate, and we're starting to see ripple effects in terms of the credit crunch getting deeper because there are so many charge-offs happening at the bank. So that's something that we're tracking very closely right now, because commercial real estate transaction volumes have picked up appreciably. So now we're going to start to finally get the price discovery in this critical market that we've been waiting for so many years as lenders have extended and pretended.
Okay.
But that time appears to be up now.
All right, let's follow up on that research. That sounds really interesting next time. So anyway, thank you for thank you for your updates this morning. Well needed after FOMC Fed Day. We'll speak again next time. Thank you.
Sounds great. Take care, David.
And thank you for watching. Don't forget to like and subscribe.